Great. Well, firstly, thank you very much indeed, Tanya, for inviting us on the show again. It's always a pleasure to take part in these things. And quite frankly, it's not very often that we do get the chance. And when we do, we always like to put together a special presentation. And today we're going to talk to you about a trend-based strategy you can bank on. And these strategies which we're going to talk to you about have been road tested, and they can work on any market and actually in any time frame as well. So if you don't trade end of day or end of week like we do, don't worry, you can apply it to whatever you do trade. So those of you who don't know me, my name's Robert Colville. I founded the brand The Lazy Trader back in 2012, and what a journey it's been. I mean, when I first started trading about 11 years ago, it was certainly not a walk in the park when I first started. In fact, I made every single mistake conceivable under the sun. And I have absolutely no bones in telling people about them, okay? And I feel that after going through the motions, which a lot of you may have experienced yourselves, or may be in the process of experiencing, then you can certainly empathize with me. Back in the day when I first started, I was rubbish at trading. I went long when I should have been short. I sold when I should have bought. I mistook a currency for a commodity. It was a nightmare. But after a while, I figured that, hey, I couldn't possibly get any worse than I was. So I identified the fact that all I could do was get better. And that I did. After about 1.5 to 2 years, I gravitated towards the style of trading, which really did kind of identify the sweet spot for me, which was enabling me to get as much as I possibly could from financial markets, from essentially doing as little as I could. Okay, and that's a sweet spot, getting the most I can for as little work. And sure enough, I've been around the block a bit. I've traded the 1 minute chart, the 5 minute chart, the 4 hour, the 20 minute, a tick chart. And you know what? Out of all those experiences, I can really just sum them up as being a loss-making time waste. And it's certainly, if you suffer from male pattern baldness or high stress levels, then I would really not recommend trading anything less than the daily or the weekly time frame. It's the only time frame, whether you're trading currencies, commodities, stocks, any kind of asset class really for that matter, where you can essentially transform what is experienced by many people who trade as an expensive stomach churning activity into a carefree and relaxing hobby. Okay, and that is because if you trade the daily chart, you only have to look at the markets once a day. If you trade the weekly chart, which I'm a big fan of, it means that you can identify opportunities, analyze markets at weekends when the market is asleep, and just set your trades up at the market open on Sunday night or Monday morning and just walk away and do something slightly more interesting. Okay, so since founding The Lazy Trader in 2012, I've since taught thousands of people around the world from all walks of life how to trade in the style of The Lazy Trader. We trade the daily chart and the weekly chart. That is it. We accept that there are far more interesting things in life for us and for you than just looking at a bunch of lines on the chart all day. And it frees up time to really kind of give me extra freedom to exercise my real passions, which is I love playing tennis, the gym, working out. I don't laugh. I'm learning salsa at the moment. And of course, I do some mentoring for the Prince's Trust, which essentially focuses on helping people from disadvantaged backgrounds in starting up their own business from scratch. And I have 4 clients from that, and it's great fun. Okay, so that's enough about me. I can really prattle on all day talking about myself, but I've been pretty sure that you did not take time out of your valuable time out to hear me talk about myself. So let's talk about really the pith of this presentation. So what we're going to do is talk to you about trend trading and why you're essentially following the smart money and why you've got the probabilities on your side. Okay, we're going to talk to you about specific entries, how to manage the trade, and how to exit. They're as crucial as finding the opportunity in the first place. A lot of people forget this. Okay, so we call this Trend Rider Pro. It's a strategy which, frankly, is as old as the hills, but it does work. And we will, after the presentation, if we have time, we'll talk to you about what trades we're in, how they're doing, as well as what is looking good on the horizon for the days and weeks ahead. Okay, so, you know, just in case I haven't really hammered this point home enough, we trade the daily and the weekly timeframes because it gives us far more clarity in amongst the noise and the madness, where you see, if you look at the 5 minute chart or the 15-minute chart, you'll see that certainly if you look at Forex, pretty much every chart is choppy and it looks like a chaotic mess. We don't like this. We want clarity and clear perspective, and the daily and certainly the weekly gives us this. We call this market structure, where we've got clearly identified levels and trends with key swing highs and swing lows. Levels on the higher the time frame, the higher the time frame, the stronger the level and the more self-fulfilling the bounce typically is. They're the most commonly, despite popular misconception amongst many newbies, the daily and the weekly timeframes are certainly the most commonly traded by the banks, the institutions, and those people who've got the clout to make meaningful moves in the market. Okay, so it means that we can piggyback big moves really quite easily without having to spend much time in front of the screen. That's the sweet spot. And certainly if you want trading to be a supplementary income for you, like I recommend, then the daily and the weekly will be your best bet without a shadow of a doubt. Okay, so every strategy has pros and cons, and it would be very remiss of me not to really give you the balanced scorecard, certainly with this strategy, which we call Trend Rider Pro, because surprise, surprise, we ride the trend and we do it professionally with a plan to enter, a plan to manage, and a plan to exit. Okay, so the pros for this strategy is that we can essentially piggyback the smart money, the big money that influences the market. There's no point us retail traders or professional traders at home with our comparatively smaller trading accounts trying to make these big moves when we can just piggyback the people who are brave enough to put their money, their balls on the line and do it themselves. So we piggyback. This is rule-based, it's scientific, so there's little scope to go wrong. Thanks to a basic set of rules, it's very binary. The setup is either there or it's not. If it's not there, then we move on to a different asset class or currency pair. The reward to risk is far greater on the higher time frames as well, and this for many people does epitomize set and forget to its greatest degree. It does not use a broad use of indicators, and many of them are overrated, and the more complicated your chart is, frankly, the more difficult you're going to make trading for yourself. This is universal. It can be applied to all asset classes and all time frames, but repeat, I repeat what I said earlier. We stick to the daily and the weekly time frame for the many benefits which I've just gone through, and guess what, I'll probably tell you the benefits all over again as well. I'm that passionate about them. Okay, so there are cons to this strategy. When I say a con, I just mean simply the downside, and that's in trending markets. Trending markets typically trend only about 20 to 25% of the time, nowhere near as much time as where they range and chop. But surprise, surprise, we've got a strategy for ranging markets, which we'll talk about another time. So it doesn't mean that we're kind of like on the sidelines watching the market doing its thing all the time without getting any action. It just means that if we're trading a trend-based strategy, we can just simply identify trending markets which trend 20% of the time. And if, for example, you're trading Forex and you are getting slightly frustrated from the comparative lack of opportunity, you can always apply these rules and this strategy to different asset classes. Remember, the S&P has 500 stocks in the Dow 30, the FTSE in England, our equity index. We have 350 stocks, the Nikkei, the CAC, the DAX. There's so many different stocks, asset classes out there. So if you don't see a trending opportunity in a major or minor or an exotic currency pair, please don't be too sad about it, because you can just apply it to something else. Okay, so in a nutshell, how this strategy works is simply buying the dip in an upward trend and selling the rally in a downward trend after we've had a confirm in the trend. Okay, so one thing we want to wait for in an upward trend is a key higher low and a higher high. You see this kind of upward trending squiggle here. We want to buy the dip on the second high low, or the third or the fourth or the fifth. We don't want to buy it on the first necessarily. Okay, that's a slightly more advanced strategy with people who've been in the market and they really know what they're doing for far longer time. But if you want the added confirmation that the trend is really solid, then we recommend buying on the second highlight or the third. Conversely, in a downward trend, we're just waiting to sell the second lower high. You can see we've got lower highs and lower lows here. We've got the first lower high, we've got the second here where our first sell opportunity is, and the third lower high, we've got our second sell opportunity. Okay, so it all sounds very simple in theory, but you know what? I can be rest assured that it might sound simple, but when it comes to actually applying it to the market, the plot generally thickens. And it doesn't necessarily need to be this way if we can just keep things simple. And one thing we do to objectively gauge speed and momentum in the market is use these three moving averages, the 20, the 50, and the 200 EMAs. EMA stands for exponential moving average. And the reason is these track speed and momentum. And of course, as traders, we want our outcome, whether it's a loss-making trade or decent winning trade, to be as quick as possible. Obviously, we can't force the market for an outcome, but it is more convenient to us if we get our outcomes, so we can essentially lock in profits, cut our losses, and move on to the next opportunity without overexposing ourselves to any one movement, whether it's risk on or risk off. So one thing we look for in this moving average, in an upward trend for this moving average combination, is for there to be sloping to the upside, for good separation between them, and the angle. Okay, order, angle, and separation. We want for the order the 20 to be above the 50 and the 50 to be above the 200. We want them to be sloping upwards, and we want decent separation between them. Okay, it says to us, if we have it in its present form, like you see before you on the screen, that we've got good speed and momentum in the market. The short, medium, and long-term traders are generally singing from the same hymn sheet, which is great because it means that the move after our buy setup is infinitely more likely than if there's confusion. Conversely, in the downtrend, we're looking for order, angle, and separation, but in a bearish context. So we want the 20 EMA to be below the 50, the 50 EMA to be below the 200. Again, sloping downwards, and there to be separation between the three moving average, because in its form, which you see before your very eyes, it's a sign to us that we've got good speed and momentum, and the short, medium, and long-term traders are all singing from the same hymn sheet. And this is ultimately what we want. Okay, so just as I mentioned about 5-10 minutes ago, we are looking for higher lows and higher highs in an upward trend. Price doesn't necessarily have to be above the moving averages. It just so happens to be in this example. Okay, so if we've got the 20 above the 50 above the 200, then that's fantastic. And that is a sign to us that if price comes back and retraces and we get a buy signal, then we could potentially go long, and it's a decent looking setup. Let's talk more about the setup in a minute after we talk about the bear market and then what we typically look for. Price, again, doesn't necessarily have to be below all three moving averages, but one thing we do want to look out for is cyclicity, lower lows and lower highs, lower peaks and lower troughs. And that's all we really look for in an ideal world. Of course, we'll look at the markets after this, and we can really apply this. Okay, so for any strategy, regardless of whether it's a trend-based strategy, a range-bound strategy, or time-based strategy, we look for timing, selection, and management. This is crucial. It's our rules for entry. So what we look for, say for example, we're looking to sell the rally in a downward trending market. We want, okay, recap, we want the 20 EMA below the 50 exponential moving average. We want the 50 moving average below the 200. And like I mentioned, lower highs and lower lows. It's the C word, the cyclicity word. But one thing we want after the market breathes out with phase one, before the phase two retracement, and we then get the phase two retracement, then a lower low, then that's the phase one, then a lower high. What we're waiting for is to take advantage of the retracement. So like I mentioned earlier, to sell the rally in a downward trend. These are all rallies, what is circled here, rallies in a downward trend. Okay, so we want to quantify it and qualify it objectively. So what qualifies a pullback or a retracement? Well, at least 3 buyer bars. Okay, so that is our rally, at least 3 buyer bars, our rally in a downward trend. Okay, so what? You're probably thinking, understandable. Well, that's all very well and good if we've got our 3 bar retracement minimum, but what about if we've got our sell signal? That we need to have in order to qualify the trade. So one thing we look for is a bearish pin bar reversal. And this is basically characterized with a tail with the open and close of the bar in the bottom third after the 3 bar pullback. Okay, so we look to sell the break of the low of this after we've had the pullback in a downward trend. Okay, a bearish pin bar reversal is a very good heads up for us because it basically tells us that The bulls have attempted to move price up even more, but they have failed, and the bears are well and truly in control. And in a downward trend where you've got the smart money behind you, or essentially you're piggybacking the smart money, it makes a lot of sense to be our trigger point. Okay, so how do we actually trade this bearish pin bar reversal? Well, what we simply do is very straightforward. We place our entry just below the low of this bearish pin bar reversal, and we have our stop loss above the high, and we place the trade. If we're triggered within 24 hours, then we're in the trade. If we're not triggered within 24 hours, we kill the order. We remove the order because the momentum is not in our favor, and that's fine because it means that we can move on to something else. So then we're in the trade. How do we manage it? Well, quite straightforward. All we do is we manage it for every second seller bar. Okay, so this is seller bar 1, seller bar 2, so we trail above the high of every 2 seller bars. No, they don't need to be consecutive, because when we're in the trade, it's a bit of a balancing act between locking in profit and giving the trade enough room to breathe. Okay, and when I say give the trade enough room to breathe, I mean it's a balancing act, because on one hand you want to lock in profit, but then you do not want to be so aggressively trading your stop loss that you're stopped out by a whipsaw movement, only to see the trade going further in your favor, but you're not in the trade. That's the worst case scenario. Second worst compared to a loss is that. It's frustrating when that happens. So a nice way of objectively doing it is trailing it for every 2 seller bars. They do not have to be consecutive. Okay, so we've got one example here. This is euro against the New Zealand dollar. We've got we've got the separation of the moving averages here. We've got the 20 below the 50, the 50 below the 200. We've got lower highs and lower lows, and we've got this bearish pin bar reversal here. You can see the longer term picture is pretty bearish here, as you can see here. On the weekly, sorry, that's a daily chart spanned over a longer period of time. So what we did, we just placed our order just below this bearish pin bar reversal, stop loss above the high, and then we tried out for every 2 seller bars. Okay, so we're able to really kind of cash out at a good gain. And there are many more examples of this, by the way. I know this example is quite old, but we'll go to the markets in a minute and show you some more examples. So let me talk to you about a buying opportunity in an upward trend. Okay, there's no point going against the overall grain of the market, because that's what amateurs do, that's what idiots do, and they're always trying to second guess the direction of the market. The human mind is more predisposed to going long than is short anyway. Apart from me, when I was new, for some reason I loved just trading reversals when I was new to trading, and I quickly realized that they were nowhere near as probable as trend-based trades. And whether you're new or medium, you've got a kind of medium experience in trading, trend-based trading just makes a lot more sense for our psychology, because it's far better to have smaller wins and more of them than more losses than wins, yes, bigger wins. It's just far better for our equity curve as well as our sanity, dare I say. So buying opportunities in an upward trend, it's basically exactly the same as what we just discussed, except it's the other way around. We look for the 20 EMA above the 50, the 50 EMA above the 200, and we looked to identify higher peaks and higher troughs. And what we've got here is a 3-bar retracement of seller bars, and we are just simply looking to take advantage of this dip in an upward trend, buying before the market breathes out again. So we've got phase 1 extension, phase 2 retracement, phase 1 extension, phase 2 retracement. There, you get the general gist. So then what we want to wait for, apart from the general profile of the market, which we've got, is our activator bar, our signal bar, to actually go long in the market. And this can be characterized as a low test bar, also known as a bullish pin bar reversal, where we've got that iconic tail and the open and close in the the top third of the bar here. That is crucial. Okay, so this is our launch pad, if you like, to get us into a bullish market after it's breathed in, before we essentially, hopefully, continue with the continuation of a phase 1 extension. Okay, so to trade this one, we'll just simply place our entry above the high of this bullish pin bar reversal, stop loss below the low. And if we're triggered, what we simply do, if we're triggered into the trade, is we objectively trail our stop loss below the low of every second buyer bar. Once again, they do not need to be consecutive. They could be evenly distributed between seller bars. It's absolutely fine, because once again, it's important for us to essentially systematically, I repeat, systematically lock in profit, as well as give the market enough room to breathe against us. A lot of people are too aggressive of trading their stop loss, and I'm sure many people, including myself, can empathize with the fact that, okay, you might have had a a fantastic opportunity which went to the stars, but you were in the trade and you're so keen to bank profit, you're too aggressive and you got pipped out at a small gain. The problem is the trade's gone far, far, far more further in your favor, except you're not in it. And that's horrendous. It's almost as bad emotionally as just watching a losing trade, because you're just mindful of all the upside. Here's an example here. This is the British pound versus the Australian dollar. I remember this all too well. This was a pullback and an upward trend. And we simply had the bullish pin bar reversal on the eve of the general election between Labour and the Conservatives. We don't really care about news. We just place our trades regardless. Who cares about news? Like I said, we want this style of trading to be a peaceful and lucrative activity, not a burdensome kind of ball and chain to keep you at the desk. That's the worst thing. If trading was like that, I would certainly not be doing it. I'll be doing something else instead. I can honestly say that from the bottom of my heart. Okay, so again, we tried our stop loss below the low of the second buy bar. Even some people could say this style is too aggressive, as you can see here. We got stopped out pretty early, but we did still make a decent about 4% gain. We risk 2% for every trade, not 1%. We always say risk 1% of your trading account per trade until you're profitable for 6 months at least. Okay, once you have achieved that, then by all means risk 2%. It just makes a lot of sense. Okay, so let's find some examples here and talk to you and apply this to actual markets, because it's all very easy to really kind of like talk to you in hindsight with picture perfect examples, but I'm not a fan of doing that, because it's essentially let's talk about the US dollar here versus the Norwegian krona. This is a trade we recently took. We took this one. We can see here that the dollar unfortunately has taken a bit of a pounding, as I'm sure you're all acutely aware, coming from the United States, or most of you from the United States. But one thing which we did do, and this is something which you might be interested in, certainly if you're looking to hedge against the weakening dollar, is the fact that we have this, what is essentially a downward trending market. This is the US dollar versus Norwegian krona. Just an example, it's a Scandi. It could be any currency pair. It doesn't really matter. The fact is, we're just decoding the story on the chart for what it is. We'll trade this exactly the same way as if it was, say, for example, the British pound versus the US dollar, or indeed dollar Swiss, US dollar versus the Swiss franc. So the fact of the matter is we have lower highs and lower lows. We've got the 20 below the 50 below the 200, and we've got this bearish pin bar reversal here. There we go. So what we did was we simply placed our entry just below the low here. This was towards mid-Feb. Stop loss above the high, and we were triggered into the trade quite quickly. There we go. Started trading for every 2 seller bars, so we locked in profit along the way. There we go. So we locked in profit here after moving there. There we have it, and then we've got seemingly a higher low for the US dollar. It seems to be in a bit of a chop territory at the moment. So that was US dollar versus Norwegian krona. I'm going to talk to you a little bit about gold as well, because this is something we've been trading quite heavily lately, ever since the Santa Claus rally. Let me talk about this particular setup. There we go. So as you can see here with gold, precious metals, just a bit of inside information, or not inside information, just kind of extra heads up that historically, from mid-December towards the end of February, gold is seasonally very bullish, just like equities are from basically mid-December onwards. They call that the Santa Claus rally, where essentially you get this kind of hubris in the market. People are essentially just really keen on buying, and this has historically been the case. But it's the same for precious metals. So gold, we saw this when an upward trending market very nicely, thank you. And we have the 20 above the 50 above the 200. We have this, surprise, surprise, bullish pin bar reversal here. So we place our entry above the high, stop loss below the low. Our first target would be the previous swing high, of course, because this setup happened towards the beginning of February. So we know full well that it was a shallow retracement as well. Looking at this here, there we go. There we go, shallow Fibonacci retracement, 382. In a strong bull market, 382 is a fantastic retracement, because if price doesn't go below that, the 382, then it's a sign that the bulls are well and truly in charge still. And certainly what we did with this bullish pin bar reversal, as per our rules, we simply just place our order above the high, plus our stop loss below the low, and then we got triggered into the trade, just about. There we go. There we go. If you trail for every 2 bars, I mean, that is one tactic for management. You would have had a break-even outcome here. What people tend to do, and we advise people to do this as well, because it gives your trade yet more collateral, is to simply scale out at a 1-to-1. And that's essentially what happens there, is you are able to kind of like break even, lock in some profits, break even, and keep your stop loss in its original position. So you've given the market even more room to breathe. Okay, so we're currently selling gold at the moment, funnily enough, because we had this bearish pin bar reversal off this well-respected level. But we think that gold is potentially going to come down to 1300. There we go, big round number. And if, as and when it does, we'll be looking to buy it round about there. Okay, originally we were in gold from this point here, from this bullish pin bar reversal, stop loss below the low, on a slightly different strategy to one we're talking about, but it was still valid. So we've been in gold for a long time. If we look on the monthly time frame, funnily enough, with gold, let me show you very quickly. Let's just go down to the monthly. You can see gold is very bullish on a macro scale here. We can see that ever since 2001, since the kind of like historical low, we've had this enormous bubble all the way up to 2011. We've had the retracement back down to the 50% retracement, and it looks like we've got a double bottom in play at the moment. And gold, frankly, it's the safe haven if, as and when there's a bit of flight to the US dollar as well, because of course equities are grossly overvalued at the moment. You don't need to be a rocket scientist to figure out that one. They're just stupidly expensive. Okay, so let's talk about some other trades which we took. I mean, please bear in mind, I mean, we're looking at the the daily time frame. This works certainly on the weekly too. Okay, so I am going to take you to as well this one here. Sorry, it's got a bit of, it's just a bit slow. A lot of currencies are moving sideways at the moment, and that's absolutely fine, because what we can simply do if they're moving sideways, like the British pound versus the Norwegian krona, is essentially look to buy the bottom of the range and to sell the top on a slightly different strategy. There we go. I mean, we have the US dollar on the versus the rand as well going downwards. What we are essentially looking for are selling rallies in the US dollar in terms of the now. I mean, looking at dollar rands, for example, we are just simply waiting for a pullback. There we go. We can see we've got fantastic order angle and separation between the 20, the 50, and the 200. And all we're simply waiting for is a bearish pin bar reversal after a pullback. It doesn't matter if price is above the moving averages, as long as the moving averages are in order as well. This is the same with a lot of different kind of currencies, with the US dollar as the terms currency. Dollar CAD, slightly different here. It's moving sideways. That's a kind of an exception to the rule. Dollar SEK, also a Scandi. We are just simply waiting. Let's go down to the weekly here. There we go. We haven't quite got the moving averages all crossed over yet, so that is not valid, unfortunately, on the weekly or indeed the daily time frame. But we do have a very nice range here. Okay, so if, as and when price does get to the top of this range, okay, it broke out early in 2016, but you can see this level has been tested once, twice, thrice. It's a decent soft level of resistance, so represented very decent sell opportunity here if you indeed entertain or indulge in supply and demand trading. One thing I do want to talk to you about is the British pound versus the Swiss franc. Okay, and this was a fantastic run which we had. This was certainly Brexit year. This was phenomenal. Okay, so what we did was looking at the fact that let's just go to the weekly and show you. You can see here before Brexit, let's just simulate this back. Before Brexit or anything like that, we saw that this currency pair was in a range. It hadn't left this range, this level of support, or indeed this level of resistance. And quite frankly, if as and when price gets up to this level, it makes sense to sell it because the bounce is more likely than the breakout. So this is exactly what we did all the way back in 2016. Let's just go back there. We sold it as a reversal. And reversals, aren't quite suitable for the absolute beginner, but certainly there is an art to it. So we traded this bearish pin bar reversal as a lower high. There we go. Entry just below the low, stop loss above the high, just like the power zone strategy or the Trend Rider Pro. So we've got triggered into the trade. We can move it to break even. But the great thing about big ranges on the higher time frames is that you can get trends inside ranges. Okay, so we had this instance. You can see now at this point that we have lower highs and lower lows. So we're just waiting for a pullback. And that's exactly what we did. We added to our position. So there we go. We have a pullback. Do we have a bearish pin bar reversal? There we go. We've got a bearish pin bar reversal. So what we did was we sold this rally in this downward trending market. We've got the 20 below the 50 below 200. Great order angle and separation. It means that the bears are well and truly in control. We've got this rejection, it's bearish pin bar reversal, which tells us that, hey, price has dared, got up to this extremity here, but the bears have come wading back into the market, forcing the bulls downwards. So we placed our entry just below the low, stop loss above the high, first target, the previous swing low. That's generally a decent target, or sorry, just above the previous swing low, my apologies. And that's exactly how we traded it. And there we go. The old expression is that the bull climbs the stairs, the bear falls out of the window. We had another opportunity to sell here. There we go. So just to give you an example, I mean, a lot of people say, oh, well, most currencies at the moment are range bound. Yeah, absolutely, they are. But if you look on a higher time frame, you can see trends of inside these ranges. And funnily enough, with the British pound versus the Swiss franc, I'm actually just waiting for it in the daily time frame to go long again. I mean, we've already had that crossover. It's a bit jagged at the moment, but the fact of the matter is, in Britain, we've absorbed all the bad news we possibly can with Brexit, depending on whether you see that as bad news or not, and of course the prospect of a socialist Labour government in 4 years' time. If the Tories lose their majority in the House of Commons, that would be a disaster in my opinion, and the pound would certainly not like that. But essentially, the British pound, cable has absorbed all the possible bad news it can, and I'm looking now to buy dips in the recovery. I mean, the British pound is, maybe with the exception of today, slowly recovering against the US dollar. There we go. We've got great order angle and separation. We've got the 20 above the 50, 50 above the 200. We're just waiting for a clean pullback. I'm actually not a fan of trading the British pound versus the US dollar because it's very jagged. I prefer trading the pound crosses. I was going to talk to you about a more recent opportunity we took with Euro Swiss. I know a lot of people despise this currency pair as well. Oh, I'll tell you what, with Euro dollar, here we go. Let's just give you an example. We're still an upward trending market. We've got the 20 moving average above the 50 above the 200. If we close as a bullish pin bar reversal, we could actually see this as a potential buy opportunity at the end of tonight. We shall see. I will say I prefer trading this strategy on the weekly time frame. The weekly time frame for me has far more strength with the moves than the daily time frame, and the moves are a lot more entrenched than the daily time frame. The daily time frame in comparison is a lot more choppy, if you like. Okay, so that is essentially it. We're waiting for, okay, this is going to be interesting. Waiting for a pullback, certainly with Euro CAD. We've got it here. We've got vehemently trending market. You can see how much speed and momentum is with the euro versus the Canadian dollar. We've got the 20 moving average sloped up above the 50, above the 200. We're just waiting for a free 4-bar pullback punctuated by a bullish pin bar reversal. If, as and when we get the bullish pin bar reversal, then we'll look to take the trade. Okay, and it doesn't matter, once again, if we get the trade set up below the 20 or the 50. It doesn't matter at all. Okay, one thing to bear in mind though about this currency is the brick wall here at 1.600, because as you can see here on the weekly time frame, this is where we use time frame correlation to kind of qualify whether a trade has room to essentially go. We've got this enormous big number here, and price you can see here all the way back in early 2016 whiplashed off it. It's likely it's going to happen again based on the fact that it's done it on this occasion. We've got the completion of a three wave harmonic pattern here coming into this level. So this is all the research, moving on from the strategy, this is all the kind of research we do in advance of these enormous mega moves. And I love trading reversals, okay, because it means I can really get into the move at the very beginning and trade any subsequent trend later on when it forms. So just like with what we did with the pound Swiss, what I've looked to do with this is simply place a sell order on this level here, stop loss 100 to 150 pips away, trade bearish pin bar reversal off it as well if we get it. If we don't get it, then that's fine. If we get the reversal off it and when we see lower highs and lower lows on the daily time frame as price falls back into the mean, then I would look to sell the rally in what is essentially forming to be a downward trend inside a range. Okay, so you can see that this is a range bound market on the weekly time frame, but if we go down to the daily time frame, we've had trends inside ranges. Okay, so that is essentially a bit of an insight into a trend-based strategy and how we look for opportunities in these markets. And I trade as many currency pairs as I can. A lot of people say, why do you trade the exotics like pound versus Norwegian krona or euro New Zealand? Well, the simple answer is it's just a currency pair. And every chart tells a story. And regardless of what countries the chart represents, every story can be decoded. And if it can't be decoded, worst case scenario, then it probably isn't worth trading in the first place. All right, so one simple expression I have is based on the Trend Rider Pro is if you don't see a setup, then just stay out. If in doubt, stay out is essentially what I'm saying here. Okay, one thing I want to draw your attention as well for those people who trade commodities is the fact that we have with oil, we've got great order angle and separation. We've got the 20 above the 50, the 50 above the 200. It's still bullish for now. If I get a higher low here, like we'll look to take it. We didn't quite get a bullish pin bar reversal here, unfortunately. If we did, we would have taken that. But if we get a higher low and a bullish pin bar reversal anywhere between 60 and 58, then I'll certainly look to take it long again, because we've got enough room to move for crude oil. February and March are seasonally very, very bullish for crude oil as well. So that is what I am looking at in terms of riding the trend to the upside. Okay, so I could talk about this all day and all night long, but I know we're kind of quite strapped for time. We've only got 5 minutes left and we've got questions as well. But one thing I really want to emphasize is trading the daily and the weekly time frame has so many benefits, because it means that you can set your trades up and walk away and go about more interesting things than trading. Because quite frankly, looking at a bunch of moving lines on the chart all day, every day, isn't particularly that fun or interesting or impressive, actually. So it's a difference between you working for your money. Any intraday traders in the room will probably, and I can certainly speak from my own experience, where you really do feel like you're working for your money when you're nursing those trades on taken on the 5-minute chart or the 1-minute chart, God forbid. So money working for you versus you working for your money versus your money working for you in the background. That's what we do at the Lazy Trader. We have all of our trades on autopilot, set and forget, so we can go about doing other things. I'll be honest with you, I don't really like playing golf, but I certainly like dancing, I like working out, and I like hanging out with my friends and family. That's what I enjoy doing. And of course, adding value where I can, and doing work for the Princess Trust, which is what I do to give something back, because I do feel slightly selfish just making money all day in financial markets. So I do want to give it back from a kind of karmatic point of view. So lifestyle trading, i.e. trading the daily and the weekly time frame, is fantastic because it frees up time. It removes emotion from watching the charts all day. It's the difference between you working for your money and your money working for you. Crucial difference there. You can benefit from the stability and relative predictability of the kind of higher order time frames. You're more immune to news and intraday spikes. We don't really care about news or the Federal Reserve or any of these big kind of policy announcements or interest rate decisions. We just let the market ride us like a catalyst, or act as a catalyst to projecting or perpetuating the trades we've got on, whether they're losing or winning trades ultimately. Okay, and of course, trading on the daily, weekly time frame, trades are far less time consuming to manage, and that's a biggie. Okay, so one thing we want to do today in conjunction with Traders Talk Live is to offer you a reward for obviously taking the time out of your schedule, and to reward people who are prepared to take action. And that's give you access to our ultimate program, which is valued at $1,997. This is completely dedicated to essentially teaching you how to become a profitable and successful end of day trader. We share with you absolutely everything. We've just been and have had our courses accredited by the CPD. We've got a very high rating on the Forex Peace Army, and we have a satisfaction guarantee. If you're not satisfied, we'll just give you a full refund, and no problem, no love lost. We'll give you access to everything, how to trade any asset class from as little as 10 minutes a day. It's applicable to any market, any time frame, although we only really recommend the daily and the weekly for the said benefits we've mentioned time and again. This is just a sneak peek of our app-driven members area, new. It's state of the art. You've got access to everything. We don't hold anything back at all. We give you access to our trade ideas, weekly market analysis. We have guest traders, trader psychology, a forum for you to let off a bit of steam, extra bonuses, podcasts, strategies, both basic and advanced, how to trade videos, flipbooks, podcasts. We've got a pattern recognition software, a traders university. So you can, this is new, by the way, this is being developed as we speak. We've got this traders university certification, so you can apply all your knowledge to this examination we have, where you can get a distinction or a merit or a pass, depending on how ambitious you are. This is professionally recognized by the CPD, and I would love to see your name on it. Valued at $1,997. We're going to give it to you today for $1 access until midnight tonight, New York time. Just $1 access. Like I said, you get access to everything. You've got bonuses, which we have Trade Voyager, which pinpoints essentially bullish, bearish pin bar reversals, inside bars, outside bars, engulfing bars, and it will just essentially help be your template or your sat nav when it comes to trading. So you can essentially identify these setups and cut out even more time. We've got a Traders Hypnosis audio pack for you, which has been developed by our very own Kaylee, and this has gone down very well with our traders, actually. So there you have it. I will say this is a subscription program, so if you didn't want to roll over to the subscription at the end of the month, which is $160 per month, just let us know, no problem. But instead of $250, which is what it costs on the website, we'll give you access to for it for $1. All you need to do is go to our website, thelazytrader.com/Forex training, buy the ultimate program, read the terms and conditions, use the promo code Traders Talk, lowercase, one word, hit apply, and that will give you your discount. But it only lasts until midnight tonight, New York time. So please, if you do want it, please go ahead and get it. No love lost if you don't, but we look forward to welcoming you aboard if you do. Okay, thank you so much for your time, everyone. I've had a great time doing this webinar. So please, if you have any questions, drop us a line, tradingfloor@thelazytrader.com, or just ask now if you want in the chat box. I'm not entirely sure how to get that chat box back. Let's see. There we go. Sorry, this is the chat box. There we go. So if you can't think of anything now, just drop me an email. That's absolutely fine. And we can just talk one-on-one. One thing that people generally ask me is, okay, the standard question is, if I don't enjoy trading, why do I do it? Well, the fact is, it's true. I actually don't enjoy trading that much. I'm more interested in what it can gain me. And this is why I trade in this style, because it enables me to free up time to do what I actually enjoy doing, like working out, learning new things, and helping people, basically. Can you scalp the longer term time frame charts? You can do, but I wouldn't recommend it. The benefits, one of the core benefits to trading the longer time frame charts is simply going for higher reward setups. Does your system run on MT4, MT5? It can run on either. I use eSignal as my charting software, but it's universal. You can use it on MT4, MT5, Pro Realtime, your broker's platform. Your broker might have a different platform to MT4, although most brokers do offer MT4. So yeah, it is available in that way. Yes, good question. There's auto renewal, but you can cancel. Please give us 7 days notice, and we'll honor that cancellation. Okay, but lots of people, what they do is the average time people spend as a client of ours is between 6 to 8 months, and hopefully you will go and become a member for 6 to 8 months. If not, you know, everyone's different. That's absolutely fine. But we figured that this kind of approach is far better than just charging a lot of money up front, like some courses and some training providers do. Okay, so that is it for the questions. If you think of anything you want to kind of ask me a bit later on, just drop me a line, tradingfloor@thelazytrader.com, or just simply rob@thelazytrader.com. Guys, thank you very much indeed. It's been a pleasure, and thank you very much indeed, Tanya, for inviting us onto the show. It's always a lot of fun doing these things.